Live from New York City this morning. Good morning, good morning. Kicking off a brand new trading week with equity futures basically unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York City, we begin with the big issue, yield curve inversion.
The yield curve inversion.
It's an alert but not alarm signal.
The inversion of the yield curve raises the risk of recession.
That's a more challenging environment for equities.
But there are a number of ways to define this.
It's telling you that the economy is strong today, but it may not be in the future.
You need to dust off the checklist for a recession.
It's telling us one other thing.
The truth tends inverting.
It's telling us that the Fed's policy reaction function right now has moved very, very much towards fighting inflation.
In terms of the bond market of yield curve inversion,
this is where the debate is being had.
This is the markets readjusting to a much faster pace.
If they don't get what they want,
if the Fed needs another lever to pull on to fight inflation,
expect them to be even more hawkish.
Joining us now to discuss Morgan Stanley's Katerina Simonetti, Schwab's Collin Martin, and Krishna Memani of Lafayette College. Let's start with you, Katerina. I want to come straight to what's happening with the yield curve. Just about negative 2/10 right now by 3 basis points. How useful is this as a measure of anything?
Well, I think, Jonathan, the biggest concern here is, is this something that is going to indicate the fact that we're going to have a recession in the near future? And in our view, it's not necessarily so. We're concerned about the market. We're concerned about valuations. And there are so many risks that we have that we're dealing with that we had before the war in Ukraine started, which of course amplified the situation. But as we're looking at the yield curve, it's one of the components that makes us a little bit concerned about the recession, maybe not this year, but perhaps in 23.
You can pick your period, any period that explains why things will be bad, why things will be good. David Costin of Goldman Sachs picking up on this period right here. Take a listen to this. The S&P has typically posted positive returns in the 24 months following yield curve inversion, but the early 1970s experience when the S&P entered into a bear market offers an example of the downside risk to equities amid the current high inflation environment. Krishna, can you respond to that?
Well, so I think the key point here is focusing on inversion is really looking at a mirror. It's telling you things that you already know. The Fed is going to tighten, and the Fed is going to tighten aggressively. And even the Fed has no idea how much it will have to tighten to get the current bugaboo of inflation under control. In that sort of an environment, kind of looking at yield curve and what happened in 1843 or 1937 is somewhat irrelevant. The fact of the matter is the Fed is on a tightening path. And the tightening path is extraordinarily uncertain on the upside. That is, they are going to tighten a lot more, perhaps, than what the market is discounting.
You think there's big upside risk, and that's something echoed really in Jamie Dimon's annual letter as well. It read the following: the stronger the recovery, the higher the rates that follow. I believe this could be significantly higher than markets expect. Collin Martin, do you agree with that?
Well, I do think there are a lot of risks out there when you consider what the Fed's telling us and their aggressive outlook, and really the markets are mirroring that with their aggressive expectations for the pace of rate hikes. The Fed is telling us that the economy is strong enough to withstand this. They're telling us that the labor market is strong enough to withstand this. I'm not convinced just yet. I do think there are a lot of risks out there where I don't think there's necessarily a huge upside surprise. I think the big risk is just the demand destruction with inflation, and that's money spent at the pump that can't be spent elsewhere. And we were already facing some risks as we came into the year right now. And one thing we look at is, fiscal stimulus is well in the rearview mirror right now. And when you consider household balance sheets, a lot of that is really at the higher upper income levels and not so much on the lower income levels, and they're getting pinched even more at the pump. When you throw in Fed tightening, it throws a bit more of a murkier outlook right there. So we're not as optimistic as upside risks right there. We do think it's balanced, but the Fed does have to sort of thread the needle. They're telling us they're going to be very aggressive. They've told us that they are willing to be too aggressive, but we'll see where we are in 6, 9, 12 months and how the economy is really going to withstand that aggressive pace.
Well, looking ahead to May, I think the outlook is pretty clear, not murky. They're ready to go 50 basis points. The San Francisco Fed President, Mary Daly, had this to say to the Financial Times. The case for 50, barring any negative surprise between now and the next meeting, has grown. I'm more confident that taking these early adjustments would be appropriate. Mike McKee joins us now for more. And Mike, let's kick things off with Jamie Dimon's language. The Fed has a hard job to do. Let's wish them the best. They've got a tough one in front of them, haven't they?
Yeah, he said he pities the Fed and what they've got going forward. Now, Krishna said that it's like looking in a mirror when you look at the yield curve. Well, you know those funhouse mirrors that distort the way you look? You take a look at yield curves, you got to pick the yield curve because the 2s, 10s, the white line there, yep, that's inverted and it is telling a story. But what is the 3-month 10-year telling you? It is not inverted. It's fairly steep. And the Fed is also looking at the real yield curve, which is also steep, does not show signs of inversion. So pick your yield curve, pick your outlook. The Fed is likely to go 50 basis points. Now the question becomes, what happens with the balance sheet for the markets? Wednesday, we get the Fed's minutes of their last meeting, and some of these questions may be answered. They want to know what's the roll-off going to be. It was rising caps last time they started at $6 billion, went up to 30, and with MBS started at 4, went up to 20. Now the balance sheet's a lot bigger, so probably the caps are going to be a lot higher. But the question is, does it have an effect on the yield curve? Because everybody is now thinking that the Fed is going to make a mistake, even though they've only just started. Look at this. This is Fed funds futures versus Eurodollars out 18 months. And it's showing you that the market is already starting to price in rate cuts in 2024, even though we have just started with rate increases. This is a most unusual time. Hard to know what to make of it all. And as Jamie Dimon says, you got to pity the Fed.
Pity the Fed. Good luck to them. Some people might say they got themselves into this position. The Fed guessing game is a sport. You know that. We both participate. We both play that game. Have we fully clarified the reaction function, though, of what this Fed would do, what this committee would do? Mike McKee, if we got to the back end of this year and growth was slowing, but inflation was still where it is right now?
Well, we haven't clarified it, but from what Jay Powell has said, they will continue to focus on unemployment. Now, they believe unemployment's going to, they will continue to focus on inflation. I screwed that up. If inflation is still rising, now, if the economy slows a lot, they may change the pace of tightening, but they have said they're focused on inflation now, trying to bring that down. They think it'll come down anyway. We'll see over the next couple of months.
Mike McKee, thank you very much. Krishna, that question to you. Is the Fed willing to contain inflation if the price might be a recession?
So I think their rhetoric so far, really, as Mike pointed out, has been that they are singularly focused on inflation because where employment numbers are, they don't have to do anything on that front today. But the real question is, what is it that the equity market is seeing in all of this that we perhaps in the bond market aren't? And I think one has to speculate as to the resolve of the Fed. They may front load all sorts of tightening up front, and maybe they just stop because things have slowed down enough. We're doing a whole lot of things on the inflation front, maybe too hard and maybe counterproductive. I don't know if that is the case or not, but I think that probability is actually increasing rather than going down.
This is something that Mike Wilson and the team at Morgan Stanley have picked up on. And here's the quote from them coming out from over the weekend. The bear market rally is over. That leaves us more constructive on bonds than stocks over the near term as growth concerns take centre stage, hence our doubling down on a defensive bias. Investors face multiple headwinds to growth that will be harder to ignore. Katerina, can I come to you on that and ask you to build on that just a little bit more? How you're thinking about that dynamic? Back half of the year, growth slowing down. Does that become the dominant concern?
Of course. And Jonathan, we do see this as a bear market, and therefore the rallies that we're seeing, as exciting as they might be for investors, should be viewed as bear market rally. And the way that we invest into the bear market rallies, is there's a very specific tool set that we need to use. Specifically, we view this without shadow of a doubt as a stock picker's market. There's a lot of risk in index investing. We are concerned about, the growth possibility in S&P 500 as a general index, but you absolutely can find investment opportunities and attractive valuations with individual stocks and individual bonds. So, the name of the game is quality, is focusing on defensive sectors like financials, healthcare, industrials. We're a little bit less enthusiastic about goods. We're excited about possibilities in the service sector. But, as Collin mentioned earlier, I think that what we need to focus on is the effect that higher gas prices are going to have on consumer behavior. And generally, consumer is the main driving force for this market. And as we're looking for a degree of normalization for inflation, which of course is something that Fed is looking at very closely, and they're going to be aggressive dealing with this, all of that brings us to the fact that we are going to have a very volatile market. And even despite of the bear market rallies, we have to be really smart about our stock picking.
Katerina Simonetti alongside Collin Martin and Krishna Memani. Around the opening bell, I'll ask Katerina how to distinguish between a bear market rally and something actually you might want to get behind. Coming up then, we'll get through that. Your equity market's doing okay, up 0.1% on the S&P 500. Let's get you some movers ahead of the open. We can do that with Abby.
Good morning, John. And one stock that's absolutely soaring, really helping out the futures, in particular the NASDAQ 100 futures, NASDAQ tech indexes. Twitter up sharply at this point, up 21.8%, of course, on the news that Elon Musk has taken a 9.2% passive stake, suggesting a shakeup of some kind could be ahead. As for Tesla, up modestly at 0.4% after the company did its pre-announcement of deliveries, as it does each quarter. Record number for the first quarter, more than 310,000. The company managing supply chain issues well. And NIO, the Chinese EV company, upgraded to a buy at UBS. The company saying that it's attractive after the big drop, and plus NIO's new product cycle. And then finally, Starbucks, though, not so much, down 3.8%. This, of course, as founder Howard Schultz has retaken the wheel as CEO. He's cut the buyback. Investors not liking that news, John.
Abby, thank you. Coming up on the program, President Zelensky rallying support.
On our land, we are fighting Russia, which brings horrible silence with its bombs, the death silence. Feel the silence with your music. Feel it today to tell our story.
That conversation up next.
Our musicians wear body armor instead of tuxedo. They sing to the wounded in hospitals, even to those who can't hear them, but the music will break through anyway. We defend our freedom to live, to love, to sound. On our land, we are fighting Russia, which brings horrible silence with its bombs, the death silence. Feel the silence with your music. Feel it today to tell our story.
Calls for new sanctions against Russia growing as deeply distressing images of civilian casualties come out of Bucha in Ukraine. Secretary Blinken condemning Russian forces.
You can't help but see these images as a punch to the gut. We believe that Russian forces have committed war crimes. We're tightening the existing sanctions. We're adding new ones. We're doing it in full coordination with Europeans and other partners around the world.
The Kremlin denying allegations its forces killed civilians in the region, tweeting the following. All the photos and videos published by the Kiev regime in Bucha are just another provocation. Joining us now, team coverage down in DC with Bloomberg's Anne-Marie, and from London, Guy Johnson. Guy, I've asked this question repeatedly through this morning. What kind of response can we expect from the Europeans?
John, Europe has a massive and growing problem here. On the one hand, and we heard this vocalized a little bit earlier on by the CEO of Deutsche Bank, Krishna, if we see oil and gas being sanctioned, a recession is inevitable, his words. On the other hand, it is becoming increasingly clear, and you've only got to look at Chechnya and what happened in Syria, that terror remains part of the Russian arsenal. Terrorizing civilians remains part of the Russian arsenal. And there is the possibility, the distinct possibility, that we are going to see further shocking scenes coming out of Ukraine. As a result of which, what comes next is a really difficult question. On the one hand, you have a recession. On the other hand, you find yourself in a situation where you have to do something. We've got the ambassadors meeting on Wednesday, John. We've got the French who hold the rotating presidency. Emmanuel Macron talking about very clear indications of war crimes over the weekend, calling for sanctions on oil and coal. Now, remember, Russia sends around half of its oil products, its distillates, its diesel to Europe, around 70% of its coal, but gas is not included on Macron's list. And we are going to see a really difficult conversation happening here. But it looks like increasingly Europe is going to be forced down this road. But as Christian Saving says, John, that probably inevitably means a recession.
AMH, your thoughts on this? The US's role in that difficult conversation?
It is a difficult conversation that Europe is having amongst themselves, and we're already seeing divisions between the East and the West. Lithuania over the weekend, although they are very small to Russia, they did cut off imports. They will no longer be importing Russian energy. The United States, what they want to do is try to aid Europe in this potential cutting off of Russian oil and gas, the dependence they have on Russian oil and gas. When you look at already what the U.S. sends to Europe in terms of LNG, Wood Mackenzie did a fantastic piece last week. 7 out of 10 LNG cargoes are already being shipped to Europe. That is because the price in Europe and the gasoline market is so elevated, it makes sense. More LNG would need to come online around the world to be able to fill this massive hole that is going on. So the U.S. is going to be a partner in trying to help fill that gap. But at the same time, Jonathan, as you mentioned earlier, they have yet to really call out the Europeans and embarrass them publicly. They want to make sure they remain in lockstep and they are supporting them in this decision.
AMH, thank you. Anne-Marie in Washington. Guy Johnson. Hey, Guy, looking forward to the show in about 40 minutes. Don't miss that as Guy runs you through the European price action off the back of a lot of this. To Guy's point, the words from the Deutsche Bank CEO, Christian Saving, the quote as follows: a further deterioration of the situation if there's a stop to imports or deliveries of Russian crude and natural gas, a clear recession in Germany would presumably be inevitable. Collin Martin, inevitable a recession in Europe even without that?
I don't know about inevitable, but it certainly heightens the risk. I mean, it's a very difficult situation in Europe right now. I mean, obviously the conflict has a major role just from a humanities standpoint, but there's a lot of moving parts. It's a very connected, European Union, and that does pose a huge risk. I mean, in the U.S., we're trying to do some things to alleviate some of the pressure on the energy markets. But at the end of the day, this is something that doesn't appear to be going away. I mean, here we are in early April, and it doesn't look like we're getting any closer to the end right now. So when we see headlines like that, and the longer this prolongs it, it does raise the risk. Certainly, I'd fall short of saying inevitable, though.
Katerina, would you fall short of saying inevitable?
Well, Guy, inevitable is a big word. I think that nothing is inevitable, but certainly the geopolitical risks that we're facing right now, introduced an entirely new variable. And I think if nothing else, we're going to learn that, being so dependent on Russian oil and gas is not good for anyone. So is there a high possibility of recession in Europe, specifically in Germany? Yes, there is a high possibility. There is a possibility of the recession here in the U.S. But in my opinion, no, it's not inevitable. We have to wait and see how things play out.
Krishna, Memani, your take, please.
Well, so let me try to throw a bomb here. I think there is a decent possibility that we look back on the current situation 6 months from today and realize that the recession had already begun in Europe. So I think if it hasn't begun, if the current trends continue, and there is no reason to be extraordinarily hopeful on that front, I would agree. I think a recession in Europe is either already underway or it's definitely inevitable.
Krishna, if that's the case, how do you differ on your view of Europe versus the United States, of European banks, which have been a big trade coming into this year?
So I think overall, the vulnerability of European markets has been significantly higher. And for that matter, all international markets have been significantly higher than U.S. because we are still a very domestic economy. And the current growth rate has a little bit of momentum. And I think that probably lasts. I think if you look at global PMIs, they have been going down while the U.S. PMIs have gone down, but have held pretty reasonable. So I think for a U.S. investor, the case for international investing was pretty spotty to begin with, given the performance over the last 15 years. And in the current environment, I don't know how you make that case at all.
Collin, can I come to you on some of the data we have seen out of the United States? The payrolls data was fantastic. Everywhere you looked, point by point, through the whole thing. The ISM less so. Yes, it's still an expansionary territory, but it's slowing down. Is that a flashing light on your dashboard at all?
Yeah, it is a flashing light. Even though the absolute number is still strong, well above 50, that seems to be the line of demarcation. It's been declining, and expectations are for it to continue declining. So that does pose a risk. We're seeing it with PMIs across the globe right now. Now, as you mentioned, though, labor market's strong. I mean, that's the good news, and that's something that we're focusing on right now, and it's clearly something that the Fed is focusing on. Last Friday's number, with the exception of the minor miss on the monthly non-farm payrolls, the underlying details were very, very strong. What we're looking at most importantly is the labor force participation rate and the prime age labor force participation rate. That can help bring down wages. Not that we're looking to see wages get cut, but it could bring down some of those pressures that could lead to some sort of wage price spiral. We're already starting to see that while the year-over-year average hourly earnings continues to tick up. If you look at the last 3 months or so, it appears to be moderating a little bit. And if we do continue to see people join and re-enter the labor force, that's a good thing for wages and really helps us prolong the recovery and prolong just the growth we've been seeing. So it is flashing some lights. The decline is not a good thing, but there is underlying strength with the economy right now.
Collin Martin sticking with us with Krishna Memani and Katerina Simonetti. Coming up on the program, the morning calls and later, Twitter shares absolutely soaring after Elon Musk takes a stake in the firm. Dan Ives of Wedbush walking us through that story very shortly. 7 minutes out from the opening bell, equities doing okay from New York City. This is Bloomberg. We just about squeezed out a week of gains on the S&P 500 last week as we kick off a brand new trading week, just kicking a little bit higher, 5 minutes out from the opening bell, up 1/10% on the S&P, on the Nasdaq 100, up 1/4%. That's the price action here, the morning calls. We kick things off with Wells Fargo cutting its JP Morgan price target down to 150, trimming estimates by 5% to reflect a combination of seasonal factors. Next up, Loop Capital downgrading Crocs to hold, $80 price target, pointing to the stock's price evaluation and weakening investor sentiment. And finally, Wedbush maintaining its outperform rating on Tesla after Elon Musk takes a major stake in Twitter, expecting the CEO to properly balance his responsibilities. That stock is up by 0.5%. We'll get to the man behind that call in just a moment. Not Elon Musk, but the next best thing. Dan Ives of Wedbush. He'll join us very, very shortly. From New York City, your opening bell, 4 minutes away. 23 seconds away from the opening bell this morning. Good morning to you all. Here's the shape of the equity market, up 1/10 on the S&P, on the Nasdaq, up about 0.2%, squeezing out a week of gains just last week, even with that yield curve inversion we've seen so far. Let's the opening bell in New York, switch on the board and get to the bond market. The curve a bit steeper on the session today, with yields just a little bit higher at the long end and a little bit lower at the very front end of the curve. In the FX market, euro weaker, euro dollar down 0.5%, a break of 110, 109.87, and crude picking up as the session grows older, up by 3.5%. WTI 102, and let's call it 70. Around the open, about 15 seconds in, a flat open on the S&P 500. Energy top of the pile with that rally we're seeing in the commodity market for crude. Energy up by 0.6%. Utilities down about 0.6%, and one stock taking centre stage. It is Twitter. Elon Musk becoming the largest shareholder, taking a 9.2% stake. Ed Ludlow joins us from the West Coast. And Ed Ludlow, I have to say, I was not expecting this one.
Yeah, I was not expecting this one this Monday morning either. Look, first things first, that regulatory filing, 13G regulatory filing, dated March 14th. There's been a series of tweets throughout the month of March from Elon Musk asking his followers essentially what they thought about free speech on the Twitter platform. He said he'd consider his own platform, but that regulatory filing predating it shows that he's been thinking about this for a little while. I'm seeing a gain of 25% on Twitter, John, which is about $8-9 billion of market cap added in a single day, best day since Twitter IPO. That's the important chart. Elon Musk becomes the single biggest individual shareholder. Look at his stake relative to that of Jack Dorsey, who, of course, stepped down as CEO of Twitter in November of last year. This is a tough one to crack, John. Like, clearly, Musk is thinking about some kind of action, although because it's a 13G filing, this is a passive stake we're talking about. But Twitter's not done that great, right? User growth hasn't kept up with levels that the company would hope. They're going through changes with a new CEO, with Parag Agrawal. And the question is, how real is this? Wall Street hypothesizing this morning, John, that, yeah, it's a passive stake, but how quickly does this become a more active stake in Twitter?
Would you describe Elon Musk as passive, Ed Ludlow?
No.
Isn't that the issue at stake here? Hey?
Yeah.
There's nothing passive about Elon Musk. What does he want to do with this?
Yeah, look, he's been skeptical, critical of mainstream media. You know, he's talked about how he likes to follow individual journalists and their reporting, but broadly he's critical of traditional media. He is basically hinted, although we don't know for sure what his intentions are, that he wasn't happy about Jack Dorsey stepping down as CEO of Twitter, that he didn't really like the person that replaced him. But again, how much of this is fun and games from Elon Musk? How much is it a serious play? Twitter is the only public stock that Elon Musk now owns other than Tesla, where, of course, he's very much an active investor. He's the CEO. So it's going to be a hard one to read. Interesting what Dan Ives has to say, John.
Yeah, looking forward to that. I'm going to catch up with you again as well, Ed, in about 10 minutes. So don't go anywhere. The stock's up by about 22%. That's up by about $6.9 billion in market cap based on that move in the first 3 minutes of trading. Let's get you some broader moves, some bigger moves. Not as big as this one, Abby, but some moves elsewhere.
Certainly not as big as that one. And sticking with the Elon Musk theme, let's start out with the shares of Tesla, which had been higher by about 0.75%, now ever so slightly lower. This, of course, after the company pre-announced deliveries for the first quarter. A record number, more than 310,000 vehicles were delivered, suggesting the company can manage the supply chain well. But right now, investors kind of backing off a little bit. Maybe they're looking at Twitter. Occidental Petroleum up 0.9% in sympathy with oil higher, and Warren Buffett's stake is above 10%, so investors may like that too. Alibaba up 3.7% as China, of course, has made the audit news official, which will help these companies keep trading here in the U.S. And then J.P. Morgan down 1.5%. Yields basically mixed. And also, as you know, John, this company could potentially have decent exposure to Russia.
Abby, thank you. I think April 13th, JP Morgan earnings. So next week, just after CPI as well, and an ECB decision in the mix too. A lot to get through next week. This market has had absolutely everything thrown at it. Geopolitical concerns, an inverted yield curve. On the year now, it's down just 4.75% and within striking distance of all-time highs. Katie Lyons, what a move.
Yeah, about 5% off of the record high hit in early January, up 9% now from the low hit after Russia invaded Ukraine. This market is working through everything thrown its way and rallying to the upside in defiance of a lot of the bears that are out there. And from a technical perspective, the index has now actually undone a so-called bearish head and shoulders pattern, rallying past that early February high of 45.95, which could indicate, according to technical analysis, a target of around 5,200 is feasible. But of course, not everyone agrees we're headed in that direction. Mike Wilson over at Morgan Stanley saying what we've just witnessed was a bear market rally and it is now over. Worth noting, though, what led that rally basically was all of the stocks that were the worst performers during the 3-month downtrend from mid-December to mid-March. The bottom 10% of the market over that period, during which it was down 57%, now up 22% since March 14th. The second worst 10% down 41%, then up 17% since that time. The pattern holds basically all the way down until you get to the top 20% of the market during the down period. Now, of course, we are in April. Historically, it's a good month for stocks, actually the best month for the S&P 500 over the last 25 years. But there remain risks, which you, of course, just listed, John, including earnings, inflation, Federal Reserve, and now growth concerns as well, reflected in an inverted yield curve. But looking back at history, it's taken an average of 18 months from the first inversion of the 2-10s curve for the S&P 500 to top out. If you sold right at the point of inversion, you would miss out on a 19% rally on average until that top. And in 5 of the 7 years we've seen an inversion in history, the S&P 500 was higher when you're out, John.
Kelly Lights, thank you. Just a bit of breaking news. Let's cross over to Abby to get up to speed on that. Hey, Abby.
Hey, John. Well, we were just talking about J.P. Morgan, and we do have some breaking news on J.P. Morgan. Jamie Dimon, the CEO, may remain the chair, J.P. Morgan's chair, when he eventually quits as CEO. The stock right now is down about as much as it had been before, about 1.6%. Again, Jamie Dimon may remain the J.P. Morgan chair when he eventually quits as CEO. We'll bring you more information as we have it, John.
Abby, thank you. A bit more detail on that in our story from Hannah Levitt this morning. The bank plans to separate the roles, quote, upon the next CEO transition, whenever that might be. This is in a statement today. The measure remains, quote, subject to the board's determination of the leadership structure that best serves the firm and its shareholders at the time, according to the bank. Many shareholders, quote, expressed a general preference for separate chair and CEO positions. Goes on to read, I'll keep quoting this for you. Notably, a substantial majority of those with whom we engaged, including most of our top holders, indicated support for a policy that would enable our current CEO to serve as a non-executive chair at the next leadership transition. Of course, every time Jamie Dimon is asked about this, he'll keep saying 5 years, but clearly there's some thought going on here. We'll try and build on this through the hour, through the day on Bloomberg TV and a radio. Katerina, Simonetti, I want to come to you, not on this, on something else. You talked about bear market rallies. Can you help me understand how you identify what is a bear market rally and what is something that you don't want to get behind?
Of course. So over the last couple of years, we enjoyed an amazing bull market where, fueled by the stimulus, fueled by the post-COVID recovery, and investors got used to this, very attractive gains in sectors like technology, in the areas that were benefited from this post-COVID and COVID environment, as a matter of fact. And in the bear market, which in our view is exactly where we're at, we have to break out a different playbook. This market is going to show us big rallies. This market is going to show us big pullbacks, but same investment strategies that worked for us during the bull market are not going to work here. We have to pay super close attention to valuations. We are excited about the earnings that seem to be positive and about the employment numbers that look good, but we are fully expecting earnings revisions, and we're expecting them to be negative. So what does that mean? That means that we have to look for companies that have attractive valuations, that have the pricing power, that have competitive advantage, that are going to be able to be positioned to make money in this bear market. I mean, quite frankly, there's more opportunities to make money in bear markets than sometimes in the bull markets that tend to be a little speculative. So this is the time to position portfolios for quality. This is the time to dig in. This is the time to pay attention to real yields, because the other factor that we're dealing with, of course, is inflation. I mean, it changes everything. We have to look at our portfolios through the perspective of real yields, through the perspective of quality. We have to get away from the sectors that worked for us before and pivot towards quality, pivot towards the yield, pivot towards, allocation to the sectors that present attractive inflation hedges that historically worked in this environment. And, this is not the end of the world. Bear markets happen, and this is what we have right now. And, the rallies that we have, we can be excited about them, but we can't be fooled by them. We have to take advantage of them, but position portfolios for the long run.
Krishna, you know how this works. I could get 10 guests on the program and ask them what this is. Some people might agree with Katerina that say this was a bear market rally. Others might say we had a correction. This is the rally. We're still in a bull market. Get behind it. How do you distinguish between the two? What do you look for?
So I think you can only tell that this was a bear market rally in hindsight. Kind of asserting that this was a bear market rally is very difficult, just as a matter of fact. Having said that, I think I agree with their position. That is, given what we are facing, which is a significant rise in Fed policy rates and uncertainty with respect to how far they are going to go, kind of saying that we have, the bear market is over and now we are off to the races, I think is kind of difficult to square with what we face on the policy front. And I think in that, it doesn't mean that we won't have sectors of the market that will do well. but positioning your portfolio, even if you want to maintain risk exposure to equities, I think positioning your portfolio to the quality end of the market is probably the most efficient thing you can do, where you kind of balance your upside and downside appropriately.
Hey, Krishna, when was the last time you were this bearish?
Not for 15 years, for sure.
That long? I mean, the reason I ask is this a real change in tone from you?
Yeah, so I think if you think about it, the driver of my optimism ever since the financial crisis was the fact that inflation was going to remain dormant, and therefore the policy rates are going to remain low. In that sort of an environment, if you generate any bit of growth, you are going to get paid fancy prices for that. And I think in the last year and a half, all of that has gone out the window. And there's an argument to be made that it may have gone out of the window for the next 2-3 decades because overall, because of increase in defense spending and uncertainty with respect to commodities, may actually put a cap on how low interest rates can remain for the next decade. So I think this is last year was a pivot point, but it may be a bigger pivot point than what we are appreciating today.
Collin Martin, you get the final word, sir. The final word, please.
We're not as pessimistic there. The final word I'll pivot to bonds a little bit because you're talking about stock bear market rallies. As it relates to bond bear markets, we get this question a lot, and we have some good news for investors out there. We're not necessarily calling this the end of the bond bear market. We do think yields can move up a little bit from here, but we think the worst is likely behind us. When you look at that first quarter performance, there was really nowhere to hide in the bond market. But when you look at what the yield curve is telling us right now, it's telling us that regardless of how aggressively the Fed hikes rates, that neutral rate is still in that, say, 2.5% area. And once the Fed gets too tight, it's likely to cut at some point. So we see limited upside for most of the yield curve right now. But what that means for a lot of investors is that there are opportunities out there. Even though the Fed just started hiking, I think there's this misconception that yields are still low and zero, and that's not the case. Whether it's with intermediate term, long term, or even a 2-year Treasury yield, there are yields that we think are attractive right now, well above average over the past 13 years post financial crisis. So I think investors should take a look at the opportunities out there and consider that we don't think yields aren't going to rise that much further from here.
Collin Martin, alongside Krishna Memani and Katerina Simonetti, to the three of you, thank you. Coming up, Elon Musk taking a 9.2% stake in Twitter.
Technology has been just a structural margin winner over time.
That conversation up next.
Technology has been just a structural margin winner over time, and it now accounts for a disproportionate share of earnings, much bigger impact now than it has in the past.
That was Laurie Cavacina of RBC. Speaking of tech, Elon Musk becoming Twitter's largest shareholder a week after pointing to a potential social media shakeup. The move fueling speculation after Musk tweeted 2 weekends ago the following: given that Twitter serves as the de facto public town square, failing to adhere to free speech principles fundamentally undermines democracy. What should be done? On the West Coast, Ed Ludlow joins us now for more. Ed, that stock is flying.
Yeah, I look at my screen, we're up 23%, biggest jump since the IPO on November 7th, 2013. I reiterate, John, that the 13G regulatory filing for this stake in Twitter was filed by Elon Musk, dated March 14th, a good 2 weeks before those tweets about the utility of Twitter as a tool in context of freedom of speech and his questions about what should be done. And you asked me in the last segment, why is Elon Musk doing this, or what does he hope to achieve? And it's interesting, if you look at his existing holdings, the first thing that comes to mind is that this stake in Twitter is the first public stake or public company stake that Elon Musk has held apart from Tesla, right? Of course, he has private shares in SpaceX, where he's also the CEO, and Boring Company, but now this stake in Twitter as well. But it predates those questions he asked. So what's he to do about it? You look at the reaction from analysts on Wall Street, they do think that even though this seems to be a passive stake because it's a 13G filing, that we could see more active role. And so we're waiting to hear from Twitter, of course, about what they think. That's the share performance of those companies over the last 5 years. if there's anything you can say, John, it's that, well, at least Elon Musk, the head of a public company, his company has done well, why Twitter's not performed as strongly.
Hey, Ed. Thank you, buddy. As always. Dan Ives of Wedbush joins us now. We teed that up about 10 minutes ago. Dan, talk to me. Your reaction this morning off the back of this news.
I think this is just the start of Musk on Twitter. I mean, ultimately, it's not going to just end with a passive stake. I think this will be an active, past the 10% threshold. And I think this really just starts what's going to be, I think, a broader strategic initiative for Elon at Twitter.
Where does that leave your view on Tesla?
Look, for Tesla, I mean, Musk, the old view that he takes his eye off the ball, we saw it with SpaceX, and ultimately Tesla's gotten stronger. In terms of the overall ecosystem, I think investors, even I've talked to this morning, most view it maybe as a slight net positive, for ultimately Musk and the broader ecosystem. But when you look at Twitter, if there was a time that he was going to go aggressive, this was the time. I mean, apathetic share base, it's been one, I think, viewed as best days in the rearview mirror. He wasn't going to build the social media platform from the ground up. This was really what I view as just the start of a much broader campaign at Twitter.
Dan, you think this is personal ambition away from Elon Musk, the entrepreneur? Is this more about his personal views on things?
Oh, yeah, I believe. I mean, I think anyone that follows him over the last few months, I mean, this is, I think, it's crossed the line in terms of for him where it has become a little more personal. And I think it's something that, for his view of Twitter is one where he really does think that he could change the Twitter platform. This could be a new slate. It could be board changes. Obviously, behind the scenes, they'll likely talk. But then I think there's a better chance of me playing in the Masters this weekend than him just keeping a passive stake.
Well, Dan, I don't think anyone thinks he's passive. I think what we're trying to work out is what he's going to do with it. Dan, if you think he's going to be a little bit more active, what do you think he actually does with it? Never mind changing board seats and all of that. I want to talk strategy. Yeah. How would you get a read on what Elon Musk wants to do with this stake?
Yeah, I think there's probably three things. One, monetization. Monetization's clearly a laggard at Twitter. I think there needs to be a lot of changes, whether it's algorithmic or from a marketing perspective in terms of getting even new users, new demographics. So monetization, one. Two, from an advertising perspective, it's one that they're sort of viewed that they're losing in this social media game. And, I think he's going to, try to, embark changes at Twitter, which would be important. I think third, with Dorsey going more into the background, I think right now it's viewed by investors. There's a void from a leadership perspective. And obviously this goes into the whole Twitter platform. It's obviously created a lot of controversy. And I think Musk is viewing this that he's going to roll up his sleeves and try to change it himself, or at least with partners.
Key man risk is an important feature of the story over at Tesla. Dan, I'm looking at your price target of 1,400. Right now we trade at about 1076. Can you talk to me about key man risk at Tesla? What is there outside of him?
Look, Musk, there's always been key man risk, but I don't believe, at least in the next 5 years, that he resigns as CEO at Tesla. I think until we start to get FSD rolling in the second half of the decade, right now, you look at Berlin, of course, Austin, the barbecue on Thursday, Tesla and EV is really just hitting its next gear of growth. And I think there's always a risk around that with Musk, but I think what we've seen is that he started to build a bit of a bench under him. Turnovers at least, started to decrease. But right now, in terms of this next leg of the EV story, and we saw with deliveries, Tesla is continuing to navigate Teflon-like almost, where others in the auto industry, it's really been a debacle.
Dan, just quickly, Tiger, the Masters, is this going to happen?
Oh, I think he has his press conference tomorrow. I think he plays. And I think that's why this week, UNC cuts the net down tonight. Tiger plays the Masters. A fabulous week for sports fans.
I imagine you got money on that. Dan, it's good to catch up. As always, buddy. Dan Ives of Wedbush on Tesla, on Twitter, and on Elon Musk as well. Coming up, your trading diary from New York City this morning. Good morning. This is Bloomberg. happening right now. Another ECB speaker talking up the prospect of ending negative interest rates by the turn of the year. Happening right now in this equity market. We're doing better than okay on the Nasdaq, up more than 1%, about 26 minutes in, up a third of 1% on the S&P 500. That's the price action. Here's the trading diary. The President of the United States speaking later, 1:45 Eastern Time, on supply chains. Tons of Fed speak through the week. Brainerd and Williams speaking on Tuesday. Fed minutes on Wednesday. Look out for details of balance sheet reduction. Chairman Powell told us to, so we will do just that on Wednesday. Plus, oil executives heading to Capitol Hill to testify on gas prices at a House hearing. That is must-watch TV. We round out the week with another round of initial jobless claims on Thursday. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.